You're watching Dukascopy TV. I'm Elaine Stenson and I'm joined in studio now by Thomas Veillet, who's here with me to discuss economic recovery. So Thomas, we're seeing that global stocks around the world have been closing in on a 5-year high. Why do you think this is?
That's because everything is perfect. We are like in a perfect world. Everybody is so happy about what's going on now. I mean, Bernanke is supporting the market, Draghi is supporting the market, even the new guy from Bank of England, Carney, is supporting the market. They even are very cautious about what they say when they are speaking to TV or medias, and they are very cautious and they don't say the wrong word. They don't even say tapering. And when you look at the number, there is no question. I mean, jobs seems to be better. GDP from last Wednesday was great. There was no question about it. We are expecting number today that should be good as well. Everything seems to be too perfect, maybe. And also, if you look at the numbers of the quarter right now, companies are good. They are constantly beating numbers. Question is, maybe the expectation were too low, I don't know, but so far there is like a wind of optimistic on the market. Everybody is positive, everybody is convinced that the market has to go up, the economy is recovering, so there is no question.
But you're not as confident as maybe the investors out there.
No, I'm not, because the fact is there is clearly a big separation between Wall Street and Main Street. Wall Street is very optimistic because maybe they have not that much choice. I mean, the rates are very low, the bond market is almost dead, so basically the only way you have to invest is to go for stocks. And if you look at some stocks, the P's are not that expensive. I mean, the valuation is not that expensive, so maybe it's the only choice they have. But Wall Street is always anticipating the future and say, okay, the economy is recovering, the trend is there, central banks are supporting us, so we have to go further. There is no question the market is going up. But if you look at maybe the reality on the bottom, when you look at the people on the street and people who are looking for a job, it's not that easy. Even if there is some kind of improvement just by the number, but when you talk with real people and not people who are working in Wall Street, maybe there is like a small difference.
So you don't think the data that's being released is entirely reflective of the reality?
It's always a big question. I mean, calculating the GDP, when you look at the GDP who was released by the government on Wednesday and the GDP who was anticipating by the economists, there is so a huge difference. So what kind of number they are using? It looks like they are not using the same number. So it's very tough to really trust those numbers for my part. I mean, looks like it's better. It looks like also that this kind of number should tell the Fed that they should maybe start tapering. So the tapering should arrive between now and end of the year, at least, because economy is growing if you believe the number, but there is always a if you believe. Okay,
so you've just mentioned tapering there. How concerned should investors be about tapering? Because it seems to cause major problems.
The problem is the psychology of the market so far. Basically, if tapering is coming, it's bad because it means we won't have our protection on the market. But on the other hand, if tapering is there, it's because the economy is going well. But the question is, if the economy is not going that well, who's going to support us in 6 months from now? That maybe all the markets should anticipate that, but it's a very tough question. It's very psychological. So far, if you look purely at the number, you shouldn't be afraid if they take out the tapering, because it's normality. We are back to normal. I mean, there is no more support. The crisis is over. We have to start again to live by ourselves. But the market maybe needs some more time to be more confident. So it's going to be very a question of how the market is perceiving that.
So these new figures are making waves, but do you think that we are being too optimistic too soon?
I mean, if you look at the market purely, we are optimistic for a long time already. The market is coming from 666, I mean, back 3-4 years ago. And we were almost sure that at this time there will be no hope. We will die because the market was dead. The crisis was so strong. And now we rebounded for 1,100 points already on the S&P 500. People are getting more bullish now at 1,700 than they used to be at 1,000. So maybe we are a little bit too optimistic, and this is always the same story. When everybody is bullish, maybe it's time to sell, because all the crowd is already on this place, and maybe it's too late to get in. So I wouldn't say too optimistic, but I would bet on a small correction in the next few weeks at least. We need that just to take a breath, maybe consolidation for a few weeks. I would love to see that.
Okay, and I just want to come to Japan for a second, because we've seen the Nikkei rose by 3.3%. Do you think this is a direct result of Abenomics?
But the only thing I know is that everybody is very skeptical about the politics of Mr. Abe. The problem, when you look at the Japan purely on the stock market, from my point of view, when the market is going up in Japan, it's because the yen is weak or the dollar is strong. And when the market is going down, it's because the yen is strong and the dollar is weak. This was the same story for the last, I would say, 6 or 9 weeks. The market is moving that way. Oh, the yen is weak, so let's go up. And again and again and again. But basically, numbers are getting a little bit better in Japan, but there is a lot of skepticism about how this politic will work over the time. So this morning, the 3.3% of the Nikkei is not because of Abenomics, it's because of the weak yen.
Okay, so cautiously optimistic.
yeah, you can say that. I used to be a bullish. People who know me, they know that I'm a bullish guy for the last 20 years. But basically, when it's going too fast, too high, I'm very scared about that, and I try to remember what I've lived on my past, and I get the feeling that we are very close to the same kind of psychology we had back in 2000, and I don't need to remind you what happened after those huge optimistic markets in 2000. We had a huge correction, and we are also in the same way. I just take an example. I was reading this morning the number of LinkedIn, like the social network for pros. When you look at those numbers, okay, they are good in terms of expectation, but when you look at the fundamental, the PE is close to 700 already. 700 PE. I mean, what kind of growth they have to show in the next few months in order to reach some kind of real. So I'm very scared about the story that just buy LinkedIn because it's fun and Facebook is fun again. We are like in an internet bubble 2.0. That's my feeling so far.
We've only really seen growth from Facebook and LinkedIn, really, haven't we?
Yeah, but if you look at the P's and the number, I mean, if they want to deliver in the next quarter, what they're going to show that? I don't know. We are only 6 billion people on this planet, for now, at least.
Okay, Thomas, thank you very much. Thank you for joining us today.
Thank you.
And that's all we have time for now, but do check back later for further updates and interviews from the Dukascopy TV team. Bye for now.